All right, start broadcast.
The broadcast is now starting. All attendees are in listen-only mode.
Greetings, everybody. This is Jeff Scott, and welcome to tonight's live web session. Appreciate everybody coming on. I know that Ian is signed in. Not sure if Ron's here or not. I didn't have it. Should have looked before I went. And welcome to everybody else that's joined us. This will be recorded, and let's go ahead and get started. So I always put a title when I do my web videos, and I spend the weekend looking at charts and trying to get my own sense of what I think the market's going to do. And although I'm a top-down guy, I like to get a feel of the market, which is why I look at so many charts, and probably 600 charts already today I've looked at. And the title I put on it, no surprise, the time to sell in May and go away. Now, it's interesting, Barron's this week actually has something, one of their cover articles, which says maybe it's not time to go away this year. As always, well, before I get into the disclaimer, I thought I'd put this up here, and this comes out of Business Insider. And, I think a lot of people know I'm a fan of seasonality. And I use seasonality in many different ways. And, seasonality works. Doesn't work on every stock at every minute. But when you look at just from a big picture, this whole idea of buying, buy, sell in May and go away, you can see that going back to 1994, and you basically have three different, artificial indexes here. Well, not really artificial. You have the S&P in gray if you stayed long the entire time. You have the S&P in blue if you stayed out of the market in May, June, July, August, and September. And then you have the S&P in red if you were in the market only during the sell in May and go away. I can interpret this a lot of ways. I can interpret it that over the long run, you had a little bit better performance by going out of the market during that period of time, but it was less that the market tanked during that period of time, rather that the market over a period of time of 20 years, the market really hovers around that break even. So it doesn't have to blow up and have a 20% correction or a 30% correction. The market can still go up during these months. I think the last couple of years the market has had minimal pauses at any time. But it does stand out, though, that this red line looks totally different than the blue or the gray. And you all know what today's date is, and May 1st comes this week. Disclaimer, as always, this is for educational purposes only. I'm a doctor, not a broker, and you should realize that most physicians lose money with their investments. So anything I say, take with a grain of salt. And although I am very much a user of HGSI and very involved in some of the thoughts planning around it, I am independent, and at one point I paid for every tool that I use during these programs. For the sake of completeness, I like to talk about what I learned from Ian, which was Ian told me one time 20 years ago maybe that he wasn't a guru and he'd teach me to be my own guru. And I found that to become my own guru meant finding people that I trusted who had stuff to educate me and then come up with my own approach to trading that would, I think, incorporate what I thought was the best of from very smart people. In the invite, there's a comment about how I use Ron's techniques. I do. I like to use techniques that make sense to me, and then I try and add little twists to them based upon my own experience. So some of those folks who I have learned from, whether from live meetings or reading, webinars, etc., can be found on this slide, whether it's Ian and Ron of Woodward and Brown, whether it's O'Neill and then Morales and Katcher. This is certainly a scenario where the the students became even better in my mind than the teacher. It's the Bigelow from Candlesticks, Minervini and Stein, philosophies of how you apply many of the same things that we learn from Ian and others. Alexander Elder, Van Tharp, position sizing. And then I just want to mention again in the lower right-hand corner, John Person. John's probably more trained classically or involved in the futures market, although I know he does a lot with stocks. I actually participate in his board and have a lot of his tools that I purchased. And, John does a lot of the same things that we do. He just calls them different things. And he's also a fan of seasonality and support and resistance and different things that we use. I've also usually put this slide in here to say that even though I often joke and people joke about how many computer programs I have, there's a limit to how many I actually use. I need my real-time platform. I need HGSI for my analysis. I use EdgeRater. And, I also like seasonality, and frankly, I use both Magenta and Best Choice, and I'll probably look at Best Choice today because I always refer to the calendar functions, and people ask me what I was talking about. And I probably won't go much into MarketSmith, but I find MarketSmith to be complementary. It has certain things, intraday charts, which I don't get in HGSI yet. And it also has fundamentals that go out a couple of years, which I find useful for my trading, my approach. I also show you this picture frequently. And, I've got to tell you that at the first multiple times that I went to Ian's meeting in Palos Verdes, I was like many other people starting out. I want the fun stuff, which I want to find out what stocks to buy and how to make money. And I noticed that Ian spent an inordinate amount of time on the market. And as I've matured, I realized that's really what matters, and that it might be more exciting, and we certainly will in this marathon hour-and-a-half session minimum that I'll do tonight. We'll certainly look at a large number of stocks. But frankly, it doesn't matter unless we know what way the market's going to go. And this is clearly remains in that period of uncertainty. And I'm like a broken record. We go over this shoulder, and I think we're heading down. And then over the last 18 months, every time that happened, we get a little bit, and next thing you know, we have another leg up. And, we're here again. And in fact, one could argue that what we really are is dancing. And why do I call it dancing? Because as Ian likes to do his little jig of the Darvis box, that's kind of where we are here. And, the market is going through very fast ups and downs. 3, 5, 7% changes. It's a killer for the short-term trader, and the long-term trader, in that you want to go short because you think the market's rolling over, and the next thing you know, you get some news and the market goes back up. The QE's probably changing things. But when you look at the major indices and you put them on a weekly chart, you're going to see a Darvis box. And we know in a Darvis box, I'm selling resistance, I'm buying support, and I'm going to look for breakdowns and breakouts. And we're in the middle here. And, everybody on TV is bearish, and everybody's talking about the market's going to roll over. I mean, I respect Ian the most of anybody, and Ian's blog today put downside targets. And I have to admit, I think that's the way we're going to go. But no one really knows until the market opens, or really until the market closes. You try and get help with tools, and we'll talk about many of these things. Some, the bongos I was involved in, but all these came out of either adapted by rather, Ian with the Hindenburg-Omen, or introduced to us by Ron and Ian by adopting some of the other masters and customizing them to give us more information. One of the things that is so cool about HGSI is the ability to create artificial indicators, and that these artificial indexes, well, indicators too, the artificial indexes allow you to track whatever group of stocks you want. And Ian has taught us over the last 20 years, is you put together a group of leaders, and that when that index cracks, that's the time that the market's rolling over. So I really have three indexes, and they're a little bit different. The canaries, the Priceline, Apple, Amazon, Google, Tesla, Facebook, LinkedIn, and Netflix, that was yesterday's news. And we know how big they were and the run-up that we saw in the market a year ago, 6 months ago, 8 months ago. But we also know that they peaked in March, and they're falling. And if you look at Friday, and those that are new to this, you'll get the definitions later, we had a big kahuna to the downside on the canary index. You had a mobile breakdown in a squeeze, and my technicals up here, the bongos and the forest and accumulation distribution, are all red. So that really tells me that my canaries are on life support. Now, I found the dead canary, and I think the canary is closer to dead than alive, but this becomes a line in the sand. And it does have the PSAR little dots below, sitting right on that 200 as it turns out. And I'm going to watch and see as this market sells off this week, if it sells off, do we bounce and set up maybe a counter trend rally and a better place to short when we get closer to the 50, or do we knife right through that 200-day? In October, we put together a list of leaders at the time, and I'm not going to go through all of them right here, but as you can see, they've also broken through support. And this blue line is the 50-day moving average, and the price has knifed through. They also had a kahuna to the downside as well. The third index, not so bad. And this is probably the most relevant index. So if you wanted to take a checklist of reasons why the market isn't going to explode to the downside on Monday, one of those reasons would be that this list that we put together of leaders back in March has not even crossed below the 50-day moving average. Now, reality, kahuna to the downside, the forces turn red. The daily bongo here is red, although the weekly bongo is green. But if I was looking for any silver lining that the market's not going to roll over, this one has not broken yet. And these were the leaders 6 weeks ago. As far as making the slides right here bigger, I can't because this is in the PowerPoint, but the PowerPoint will be done in just a second. So what themes did I see in the market as I went through? Sort of a summary slide before I get to the charts. Market chop certainly continues. The major indices were down for the week except for utilities. The damage accelerated Friday and unfortunately led down by the small stocks. Volatility has increased, but over historic times, if you're looking for high volatility to tell you when it's time to be all clear, you're nowhere close. It was certainly a rough time for the bulls. However, as I mentioned before, since everybody is talking about a correction, does that mean a bounce might occur first? And the other thing that's interesting to me is that even though HGSI stomachs are hurting right now because high growth stocks, momentum, high beta stocks have been hammered, the indices aren't as hammered, and clearly there's been rotation. And as I went through my 600 charts today, I never knew there were so many utility stocks out there because they've really done well. Don't have many of them in my portfolio, but maybe I should. Now, this slide was actually used today by George Lee. It was created by Ian maybe 10 years ago. And I'm actually in the process of going through every one of my weekly things that I've done and then looking for the results similar to this. And the genesis of this chart was Ian's monthly meeting in Palos Verdes, where he had very smart people who each month together came up with a list of top stocks, and then one of the folks in the room kept track of performance, and they went and broke out the market into 4 types: strong, mixed weak, and weak. and then looked at performance over 20 and 40 days. You can learn a lot from this chart, which is why this chart stays in here every time I do this talk in times of market turbulence. The first thing you learn is these were smart stock pickers. 106% return in 20 days is kind of cool, but the same stock pickers in a weak market drop between 32 and 50%. So is it the stock pickers were having a bad day, or is it the fact that during a bad market, most stocks go down? I think it's that, and not that the stock pickers were having a bad day. The other thing here that I find fascinating is the 40-day. And people who know me know that I like to go from swing to position rather than swing to day. And what I mean by that is when I enter a swing position, I'm very happy if I'm able to hold that position for many months and turn it more into a position, because it means I had a big move right off the bat. But when I look at this 40-day performance, I see that even those stocks that had a big jump initially, by the time you got to the second month or the 40-day period, they've given back some. Interesting that in a weak market, 40 days out, the stocks are even worse than they were at 20 days. So market matters, market matters, market matters. So last week, I covered my short side early in the week. I think Tuesday was the day that we had a big rally, Monday or Tuesday. When we had the rally, I sold some covered calls into the rally. When we started going the other way, I sold some deep out-of-the-money puts against my Mary put positions. Those who watched my videos know that I've been mirroring up puts on all my long positions because I was afraid of what the market was going to do. By week's end, I pruned, got rid of positions, and bought some more insurance. This week, I think the first two lines will never change. I'll let the market tell me what to do, not what I think it should do, and I'll monitor my futures, my internals and contras to find early signs of a breakdown, failure, or short. Potentially, any rally will probably, in my mind, be a shortable rally, and not expecting to go to new highs. What looks strong, and we'll look at a lot of these. Energy continues strong, but the expiration stocks were not the strength. The strength looked like it was in services. Trucks, healthcare, not drugs, but hospitals and some of the services companies. Gold is stirring, as are other defensive things like utilities and REITs, especially with interest rates maintaining below 3, below 2.7 for the most part. Don't forget, cash is a position, and when it's hard to tell which way the market's going, the one thing you can be certain is if it's in cash, it'll still be there tomorrow. And fertilizers, a lot of fertilizers showed up on my review, which would suggest a wolf pack. Problem is, seasonality isn't so good for fertilizers right now. This is not their good season. And then remember seasonality. It is almost May. A couple comments about my retreat. My goal is 15 people. Selfishly, I needed 8 people to stay in the hotel, or I have to write a check to the hotel for unused rooms, so I think we're there. I've got at least 12 people have made commitments. 7 or 8 have written checks. I will consider pushing it a couple of positions more because I've had people drop out at the last minute in the past. But we're starting to get full. It's June 21st to the 23rd. It's, this is the hotel. This and this side is the intercoastal. This is the ocean on the other side. I live right about where my arrow is. I'm 2 doors down from the hotel. It's a beautiful hotel. We got a good price because it's off season, and they got great conference facilities. And I hope to help you, teach you, become your own guru, and try and do as good for you as Ian helped me early on in my days. There's my contact information, topics, basically the things that I do on this call, and then a lot of stuff about stocks, options, and money management. I'll go into great depth how I use the various tools. been spoiled by food by Ian for years, so I sort of do the same thing. We'll feed you. We'll have a nice group dinner on Saturday night and a cocktail party at my condo on Sunday, where I'll take out the expensive wine that I got to drink because my wife's getting mad at me. And it's $8.50, and if you want my TradeStation indicators, it's $1,100. And like I said, I've got about 12 people say yes, but it doesn't count until I get a check or a PayPal. So I think it's at 7 or 8 right now that have paid. The question came in kind of early, but about volume, minimal volume. I usually set my minimums at 150,000. Frankly, that's probably not enough, especially on some of the cheap stocks. They're too easy to manipulate. And when the market changes and I want to get out of it, I like to see more volume. But I've changed over the last couple of years, and I've lowered my dollars to $2, my volume at 150,000. And, you know, that's because small stocks have been working, and we'll see what goes on in the future. IQ Fusion is a site that I go to, and they've got an interesting way of looking at buys and sells, and I'm trying to decide whether it's something I'm going to maintain. But they did a nice webinar this week, and one of the things that they talked about was that every time we get a low number of S&P stocks trading above 70 on the RSI, the market corrects. And you could see at the top of the market of 07, 08, we had 10%, 11% lows, and you got a 40% correction. So that means that you had only 10 or 11% of the stocks had an RSI above 70. In the summer of 2011, we got down to 4%. We had a 21% correction. We're down to 9%. And so that would suggest another piece of evidence that we might have a correction imminent. It's IQ Fusion. Anybody that asks, I'd have to go and look it up. I've got so many sites that I pay for that I don't use. I can't even keep track of the ones that I do use. Another thing that they put out, and I thought this was just a beautiful chart, and it goes to the issue that I talked about the indexes maybe haven't had that much damage, and it's more about rotation into other stocks. And so what they've done here is they broke out large, it says small cap, value versus growth, dividend stocks, high beta, and low beta. Now, HGSI, and especially myself, live in the land of high beta. And one could see that over 6 months, high beta stocks has still had the highest return over the last 6 months. But if one looks at the last 1 month, you see that small caps have flipped to negative, that growth is less than value, and dividend payers is greater than high beta, low beta is greater than high beta, and large cap is better than small caps. So we've seen a rotation to large cap, value-based, dividend-paying, and low beta stocks. And if you're an HGSI or a small cap investor, growth stock investor like I am, that means there's been a rotation out of the type of stocks that we like. Again, there's no way you can read this. I'll give my PowerPoint to George, and he'll put it up with the movie when we get done tonight. But this is not something that you necessarily need to read, but rather pointing out you need to know what's going to happen in the market this week. You need to know that tomorrow pending home sales, whether that's important or not, is going to come out. But I know what matters. April 30th, we'll have a non-decision on the FOMC rate decision. I don't know whether or not it will be anything besides yes or no. We know the answer will be no. We have job cuts, initial claims, continuing claims, and then on Tuesday, and then on Friday, which is May 2nd, that's the big one of the month, you get your unemployment rate and non-farm, private and non-farm payrolls. The other thing that you have to know, and boy, do you ever right now is you need to know when your stocks have earnings come out. Because if you haven't noticed, even good earnings are getting clobbered. They trade up and then they come hammering down. Netflix had dynamite earnings. Unfortunately, they've had a steady stream of news outside the company that brought them back down to earth. This is from Leavitt Brothers, and that was the point of the slide. These are on their website for free, and they send you a letter every day. You can get this from Bespoke and many other sources as well. Now let's go look at some charts. So I am watching the questions the best that I can. The Nikkei is traded down 1%. When I looked before we started, the futures were not 2.6 on the S&P and 19 on the Dow and 8 on the NASDAQ. That looks like a lot, but believe it probably won't look anything like this when the market opens up. Let's see. I like to look at TradeStation for a couple of things. And you know, as I said in the slide that has a number of different books or pictures on it early on, I try to learn from a lot of different people, and I try and utilize what works. For me, it doesn't necessarily work for anybody else. So elder indicators I use on the indexes a lot. And elder likes to look, he paints the prices. Red is a sell signal or hold or sell. Blue is sort of indeterminate. Green is when the buying window is open and you're allowed to buy. And as I understand it, he won't buy when it's red and he won't sell when it's green. But it gives you a sense of what the market's doing. And if I tighten this up a little bit, during periods of good markets, it's green and blue the whole way up. And during bad markets, you get a lot of red. And red is bad, and as you can see, we've got a big red bar painted on Friday on the daily, and we're red on the weekly, blue on the monthly, clearly in a downtrend, and we're midway in the channel. That is the NASDAQ, which is going to be the weakest, I suspect, of the bunch. If I look at the Dow, it too has gone red. Last week, it was green, I believe. Now the weekly is green, and the monthly is blue. It's also in the middle of the channel. This is his auto envelope, but also, you know, doesn't look as weak as the NASDAQ, but it too suggests that we're in a sell signal. Now the other thing he spends a lot of time with is he looks at MACD divergence. And when I look at this chart here, I see that we had a higher high here than to the left, and then another high here, and then I see that the MACD is going down both from the histogram and also the lines, and so we have some MACD divergences in play here. In fact, I have these little red dots here, which are cheating dots. Those are my MACD divergence scanner. So I forgot I had those dots. So I see weakness in the Dow. I look at the S&P 500, and I see the same thing, which is red. But again, the big stocks have held up better, and you've got the weekly is still on a green and the monthly on a blue. So this tells me market under pressure. I already know that. I don't know if I concluded today. This is the other thing that I've been looking at, which to me is kind of interesting, and it's called the Commitment of Traders Report. And it looks at, this is the S&P, or the E-minis, and it looks at the activity on the E-minis from 3 different entities. They are the small speculators in yellow. That's us. They're the larger speculators, and I like to think of them as being things like hedge funds in blue. And then in red, you've got hedgers, commercials. If I'm looking at pigs and they have a big pig farm, they might be shorting or selling pigs out, selling pigs so they protect their price by using the futures market. So I ignore the red, the commercials, and I look at the difference or where the yellow and the blue is. If we look at the big run-up in the market in 2007, 2008, we see as we got near the top, we were buying, and we were buying it from the professionals, which is sort of what happens with the Hindenburg-Omen. They're selling and we're buying. The market ran down in 7, 8, in the first part of 9, and we were buying the whole way down, and the professionals were selling. First sign that perhaps we had a bottom come in is when the professionals started buying, and we were gone from the market, essentially, at the bottom. And then we kept selling while the professionals bought and the market ran up. And you know, there were plenty of people that talked about multiple times how the professionals were making all the money because the individual customers like us weren't invested. Now, of course, we're getting up near a high again, and what we see that there's been a lot of pressure or buying pressure from us. Now, the interesting thing is, and I think this is a sign of indecision, and I know it probably doesn't come out well, but there's not much blue or yellow the last several weeks. And that suggests to me that perhaps the professionals don't know where we're going either. But I get a sense at extremes. When things aren't at extremes, they're interesting to look at, but sometimes that may be it. The rest of the day, we're going to pretty much live in HGSI or some of the products that come off of HGSI, such as EdgeRater. So rather than run EdgeRater, I usually do the reports and I put them into a spreadsheet, and that way I can talk about some of these things quicker than running them. At my live meeting, just as Ian and Ron do at their live meeting, it's not just about the what, it's how you get there and when you do it. And so today is going to be all about the what. So the first thing I do in HGSI, under Designer, there's this thing called the Group Performance Analysis. And it's a great tool because you can select what groups to look at, what the duration or timing of when you're looking at them was. So I took end of day, closing price on Friday of the 18th, to closing price on Friday the 25th, just 2 days ago. And I run scans throughout the week, and I accumulate all kinds of different groups. But I specifically here am looking at the groups that were created on Friday the 18th. And then I get a sense of what the market has done, what works and what doesn't work by these groups. So first thing I do is I scan, and I see that there are somewhere about 120 groups, and there's only about 11 that were positive. Now the interesting thing is I look at what's positive. Red candle highs at a high jump, so that's a reversal sign. Reversal bears, stocks and groups to the downside, sells on my RMO system, mobile breakdowns in a squeeze, and NSP bears. My bearish searches, and these are all long in the GPA analysis, the bearish searches did better than the bullish searches. That's interesting. And then I look at the S&P 500, which over the week was down less than 0.5%. But then I look at our kinds of stocks, and I got to go all the way down to find the HGS 100 and the IBD 50 to see that our kinds of stocks were down 1.92%. In reality, this was not as painful a week as some maybe 2 or 3 weeks ago were. But if you're a high beta person, you were down 1.81%. If you just buy the 250 stocks in MarketSmith growth, you were down 1.7%. If you look at the GIF, which is one of my favorite tools, which picks the stocks that were working on the day that I ran the analysis, you were down 1.68%. The message is clear. High growth stocks didn't work last week. They worked really well the week before, so it'll be interesting to see how they work this coming week. Now, some people gave me grief and said, well, Jeff, I can't buy these stocks at the closing price from Friday run the analysis from Monday, opening of the market on Monday to Friday. And I did that, and so you see more positive, so that tells me that the market probably opened up down, and so now you're starting at a lower level, and so better chance that you traded up. Now the S&P was only down 0.13, so it was down 13.13% from the open, and the open was down on Monday. But gosh, our stocks still struggled. IBD and HGS leadership struggled based upon. Now, I'm not looking at any type of puts or call strategies. I'm not looking at protection, shorts, etc. So there might be a lot of things that I did in my portfolio or you did in yours that mitigate a lot of this downside. But the bottom is pretty clear. It wasn't a great week for HGSI type stocks. And that reminds me, I want to make a couple of editorial comments. HGSI is a software tool. I, like many others, make the mistake of meaning the same type of stocks, high growth stocks. When I say HGSI, what I'm talking about the software or the type of stocks I like. HGSI, the software, is great whether you're a value or a growth, whether you're a position or a swing, whether you are long or you're short, whether you're a big account or a little account. HGSI software could care less, and you adapt it to use the things that you want to do. When I think of HGSI, the concept, I think of the learnings from Ian and Ron and High Growth Stock Investor, and that's growth stocks. And so they're two separate things, although they have the same name. So the Hindenburg, I mentioned that earlier, automated and edge rater, when I see them, especially if I see groups of them, it tells me that the market is under pressure and is at risk of a correction. Most major corrections follow a series of Hindenburgs. Most Hindenburgs are false positives, only about 25% lead to a big change. And we're down here, and you can see there has not been a Hindenburg in the last 2 months, 3 months, and actually you can't read this, but that's December 17th. Maybe it's because I did it by my wife a good enough birthday present, because that's the day after her birthday that the Hindenburg spoke. But the bottom line is we haven't had a Hindenburg in 4 months. That might be positive if you're bullish. Bucketology, something taught to us by Ian, and it's kind of like that IQ Fusion relative strength chart of that I talked about with the market, except it's looking at the midline of the Bollinger Bands and looking in the S&P 1500, what percent of the stocks are above the midline versus below. 63% below, that's a bearish feeling number. I look like extremes. I want to see a very big number here of stocks trading below the Bollinger Bands, and that tells me we're going to correct up, or a high number above the Bollinger Band says we're going to correct down, because the Bollinger Bands define where the prices are 90 to 95% of the time, so it just has to happen that if all the stocks are above the bands, they're going to pull back into the bands and vice versa. 2 weeks ago, you may have seen the video I did, I actually took the extremes on Edge Rater going back a couple of years and plotted them on the market. And I'm not sure if Ian actually saw that, so let me tell Ian what I found. First thing I found was it's not good at calling tops. That, and Ian's often said that things can get much more extended before the market reverses. So whenever we got to the point of 20, 30% of stocks above the upper Bollinger Band, we may have gone sideways or we didn't go up as fast, but it rarely led to a big correction. Now again, the last couple of years we haven't had a big correction, so I've got to go back further. On the other hand, during that period of time, every time we had over 20 to 25% of the stocks in the S&P 1500 trading below the lower band, we hit a bottom within 3 trading days. Well, 2 weeks ago I said on the weekend we'd hit a bottom within 3 trading days, and we hit the bottom on the second of the 3 days. So we're not at an extreme. I look at another thing that we learned from Ian and I'm not going to go into the definition, I'm just going to go into the answer here, was this fourth column here. Green is when it's percent B times bandwidth, gives a buy signal. Red is a sell signal. Yellow is a churn or indeterminate signal. This is also calculated in EdgeRater using HGSI data, looking at a series of major indexes, whether the S&P 1500, the industrials, the NASDAQ 100, the NASDAQ itself, the Russell, the S&P 100, 500, mid-caps, the NYSE, and yes, I'm not sure what.
The composite. It's the composite.
Thanks, Ian. And so what you can see during, Ian always uses these great anecdotes. It's impossible not to start talking like Ian. So during the days of wine and roses, you get you shoot off 10, 15, 18 days of green, and you make money being long. You make money being long. You made money being long. Now we're in this crappy thing, this churn, and it's not even good for the guys that like to live in the short side because you can't even get, this was a great move to the downside where you had multiple days in the red. Now we're bouncing up and down and up and down. On Tuesday and Wednesday, it felt like the market was perhaps going to turn around, and then we got some kahunas to the downside on Friday. This is a tough market to trade. This in green, and frankly, the one in red, those are easy markets to trade because you get a trend, and you can make a move in a direction, and the direction lasts more than 3 days, more than 3 hours. In HGSI, and I'm not going to spend a whole lot of time here, those that spent any time with George Lee were at my meeting with George Lee. George and I both trade similar. He's a little shorter time frame than me. We like to look at stocks in a squeeze and those that are breaking out, whether it's pocket pivots, MOGO breakouts, PSAR reversals. And so Chris White, EdgeRater, has automated the signals. You can look at it from a daily or a weekly perspective. And then, Ian and Ron have been great at capturing other people's great ideas and making them more useful to us, incorporating the program. And certainly friends and family, Gil Morales and Chris Katcher, are great friends of HGSI. And, within HGSI, you're going to see code blue charts. And in EdgeRater, I can automate it as well, are just tools to find the types of stocks. And there's a list of those from Friday that meet Morales's and Katcher's criteria, stocks that are having pocket pivots, and then combining those pocket pivots with forced kahunas, bongos, etc. And you can find, coming to the top, the longs and the code reds, the potential shorts. So this is a great screening tool, and I'll show how I do it in HGSI, that allows me to understand what, or to find stocks that might be candidates for going short or going long. All right, I've got a question. Can I give some detail on this view? I didn't understand what it is showing. Uh-oh. I don't know which view that was. So if I haven't answered that, then when we get to the Q&A, last one. Is that the George Lee view? Yes, okay. So George Lee, myself, and I think Ron started to incorporate some too perhaps. The squeeze is a John Carter thing. And the squeeze is, I'm not sure he invented it, but the squeeze is when the Bollinger Bands contract within the Keltner channels. Dan Fitzpatrick calls it volatility squeezes. A lot of folks like to find stocks that are squeezing and break out from them or break down because it's kind of like a spring that's ready to uncoil, and they make big moves. So what this has done is it's automated the process, and what it looks like is, let me make this fit probably changing resolution for the meeting, for the presentation, as nothing fits on my screen. If I go to the template for George Lee, so I got to find a Canadian in a hat. There he is. Set it for daily signals. I can pick what list of securities. I'm just going to do for quickness the S&P 1500, and I hit run, and it's now going to give me a list in a second, and it's pretty darn quick, and it's telling me the stocks that met the criteria for a squeeze, and then I can. This is how long ago the squeeze first appeared. And then I could look for stocks that have various types of breakouts in the squeeze. So I might want to look for stocks that have a MOBO breakout in a squeeze, and this is one way to find them. I'll show you in HGSI how it's actually, now that we have some of these scans, even easier. There is an advantage to EdgeRater, which hopefully will be equaled soon in HGSI. And that advantage is if it's 3 o'clock, 10 o'clock, 4 or 3:30, I can go and hit this button and very quickly update the data so it looks like it's end of day, but it's not, and get an idea intra-market using 15-minute delayed data if there's any new signals. Another thing you can do in EdgeRater is to get an idea of what's working in the market, and this to me has been a great tool that's allowed me to test a lot of the things that I've learned from Ian and Ron, but also gives you a sense of what you should be buying. So this is a very short look over the last 5 days, and the first thing you see is percent gain in the market based upon ERG. ERG is EPS rank plus relative strength plus group rank. And typically the best return is in the high ERG stocks. Well, last week, remember I showed all the bearish scans were the ones that outperformed? So some of the junk in the market was rotating in while the leadership was flat to down. Now this higher part, high ERG number, there's very few stocks, so I always disregard from about 280 over. And the sweet spot to me has been the 240 to 280 area. I look at return versus EPS rank. This is the highest rank, 90th percentile. This is the lowest rank. What does it tell me? That stocks that didn't make money actually did better, who had lower EPS rank actually did better last week. That's contrary to normal. High relative strength stocks had worse performance. Group rank didn't seem to be a big difference. And then the big giveaway that the market was rotating out of the good stocks was the fact, well, first of all, you have everybody underperformed, but actually those that had distribution, and all these numbers, EPS, relative strength, group rank, boxes, letters, this came on data from last weekend. So it was what it looked like on April 21st, not today. Stocks that were distributing actually did worse, which you might expect to see. The more distribution, the worse performances. And over 1 week, I don't see a whole lot to talk about from the boxes, but everything did poorly. And when you figure that box stocks are stocks with lots of EPS growth, it's not a big shocker that the stocks with the highest earnings growth, which many of them are high beta stocks, are the ones that performed poorly. I compare that to the last month, and I noticed that same pattern has been here. Distribution stocks have done poorly. Relative strength over the last month, since the market has underperformed, high relative strength stocks have not done well. This is that market rotation out of high relative strength, high beta stocks. Now, if I look at year-to-date, you see this interesting phenomenon, which again, the stocks that were out of favor. This data here reflects data that I have in the market from the 1st of January. And those stocks that were in distribution as we went into 2014 have actually outperformed. It's a little early to make much of this, but I look at this because last year, on 9th or 10th month, I found that the only thing that mattered was relative strength. And that last year EPS rank didn't matter. So I started adjusting my behavior to looking at stocks that had high relative strength. So in fact, this is 2013. And this is a legitimate analysis and back test because I used the data that was available on the Sunday closest to January 1st of 2013. And then based upon that data, what did we see? We saw that you could draw a trend line. Look at this is huge percentage movement that higher stocks up to that 240, 260 range did better than lower stocks. We can see that relative strength stocks led in return, although there was no question that these biotech stocks and others that made no money, several of them had a good performance. EPS rank didn't seem to matter in 2013. Over the course of a year, you'd expect stocks that are accumulating to outperform, and they did. And if you've ever been to Ian's meetings, he teaches you about boxes, and the boxes have to do with both annual and then quarterly EPS growth. And box 1 are stocks that grow more than 50% per year, 50 to 100 per year annually, and 50 to 100% the last 2 quarters. They double in 1 year typically. And you could see that box 1 stocks had performance in 2013 of up 45% compared to only 25% of the market as a whole, and that typically box 1, box 2, and box 7 stocks are the ones that lead the way. But all of Ian's box stocks did better than those stocks that didn't have a box and didn't meet the criteria. If I'm confusing you and I'm going fast, I apologize. Go to the PV meeting, come to my meeting, and you'll be doing these own scans and your own searches. You won't be relying on somebody else. You'll truly become your own guru. A question was asked to me about pivot tables. I know what they are, I just don't. However, if you go into HGSI, you can output the entire database into an HTML file. You can take that HTML file, open it, and import it into HGSI. So if you know how to use Excel, and I know enough to be dangerous, but if you know what a pivot table is, then you know how to use it. All the data that you can find in HGSI can be found in this spreadsheet. And that means, yes, you can create pivot tables that can pull out things such as the relative strength, group rank, and earnings per share rank, ERG, and some of the other things that we talk about. So yes, you can use this data with pivot tables. And in fact, it's such a well-designed program that all you got to do is open up HGSI, whatever view you want, and I typically go up to the all securities view, and here's my limits of $2.5 and 150,000, and then this would be all the stocks that meet that criteria, and all I have to do is go to File, Save as HTML, calls it all securities. I put it into my desktop, and if I just, not that you necessarily asked, but let's say I wanted to import it. All I do is go File, Open, Computer, Desktop, and hopefully it sits right there. And now you've got the database into an Excel spreadsheet. Sometimes you wonder if things just happen this way, or was George Roberts, the proprietor of HGI, just so brilliant that we put together, he knew what he put this in intentionally. But there are certain things in this that are just so easy. Let's say that you, like me, you use TradeStation, or you use whatever program, and you have a list of stocks that you wanted to bring over, so sprinters. I go File, Copy to Clipboard, Text column. I could then go into whatever program. I could go into TradeStation and I figure out where I got some space to put it. And I just go in here and hit paste, and I just brought my symbols over to my program. In Thinkorswim, I usually save it as a text file, and then I import it. So it's a really flexible product. So let me show you how I use it to now look at what's going on in the market and what I want to be doing for next week or this week that's coming. So the first thing is, I only talked about the market because, frankly, that's all that matters to me right now. And I'm not going to put any orders in when I go to sleep tonight because I don't know what the market's going to do tomorrow. But here's how I look at the market, and I start to make that decision. In the program, under Designer, you have 3 cabinets of data: reference groups, which are everything you could think of, automatically updated splits, what's in the various ETFs, in the components. If I wanted to know, for example, what's in the direction retail 2X bulls, I can find out what's in those. Not that I really care about what's in those, but if I want to know what's in the S&P 1500, all the different reference groups I might use are there. Smart groups are pre-done scans by the various people whose names that I'll be mentioned throughout the day. And then user groups is your own file cabinet, and you can put in Ian and Ron's Woodward Brown user groups. So I'm going to go into Major Market Plus to start. On the top-down view, I'm looking at just technicals, and technicals being price and volume, force, which is calculated from price and volume, heavily weighted to the last couple of days, but goes out 3 weeks. Now, how do I know that? Because a view is composed of a filter and a combo rank. And the combo rank is going to define what comes to the top. And in top-down analysis, you can see what goes into it, and I could change the ranking based upon different things. Now, one of the strengths of this program is this view. One of the weaknesses of the program is people get overwhelmed. So let me tell you a secret. There are thousands of views. Find 5, get good at them, and don't worry about the other 995 unless you need them. This is the first view that I concentrate on, and it's top-down analysis. I apply this to ranking everything, but I use it mostly for ranking the indexes. I see that in this period of time that the leading index was utilities. I already told you that, no shocker. When you see gold, silver, volatility, commodities up at the top with utilities, you can pretty much predict that it's not a great time for small stocks. Russell, semis, small caps at the bottom, the NASDAQ. So this alone tells me where the strength of the market is. Now I could click here, this is ranking it by combo. I could look at one-day performance and see that volatility was up 5% on Friday and the semis were down 3.3%. I could look at 5 days and see the volatility, most of the gain was on Friday in volatility and utilities, and at the major indices you could see how they performed during the week. I also like to then jump into those major indices, and I go into the S&P 500. And let me explain what you're looking at here. This first panel is going to look at earnings, but there are no earnings in the S&P 500, so I'm going to kill it right now. Well, there's earnings, but not the kind of earnings that we look at from a stock perspective. So it's interesting here. I am noticing on my screen that I'm getting a fluttering of the picture, but I don't see it when I look at my other computer. But let me just make this a little, if I make it smaller, I stop the fluttering on my side. So I'm going to close off the price window. So what I have here is a number of different panels that I want to introduce you to in HGSI. First thing I want to point out, for those people that are now wondering where this view is, you don't have this view. But Ron made his view white. It cleaned up things a lot. and I'm not that bashful. I copy things at work. So I changed my picture, so I moved the pocket pivots out of the pricing window and down here. So there's no pocket pivots on this because there's no volume, you can't have them. So I have Bongo Weekly and Bongo Daily. I have accumulation distribution. I have force 13 and 2, no volume, I get no force. I have the high jump. I have DI crossovers. I have Bible gap ups. I have squeezes. And I have mobile breakouts. When I say I have, when the signal fires, that's what I'm seeing. In the price window, I obviously use candlesticks. The magenta is an 8-day exponential. The green, which is kind of running along with the gray, is a 17-day simple. The blue is a 50-day simple. The red is a 200-day simple. This gray here are Bollinger Bands. I'm going to take them off before I do the next program because you notice when the Bollinger Bands contract or squeeze, my squeeze paints yellow. So I don't have to have the Bollinger Band on to see that. On the bottom are 3 different windows. The first window will have the pocket pivots when there is pocket pivots. The second 2 are both volume on whatever is in here. On the top one, I overlay Eurekas and Phoenixes. And the Eureka and Phoenix are calculated on the market. And that gives me an idea when I see a brown or a red that the market is doing poorly. When I see a green or a blue, that's a good finding. And that's, all right, so that's the momentum of the market. So a green is a Eureka, a maroon or red is a Phoenix, and these are sort of analogous in HGSI to our follow-through days. And then down here are the things called the kahunas. Big kahunas are dark, little kahunas are light, blue are positive, and red are negative. There was a newbie question about what view is good for everything. I hopefully will leave you with 3 views that make sense to me. My favorite view for looking at indexes is the T1 view or the top-down view. When I look at stocks, I care about fundamentals. So I look at the scorecard view, which brings in both technicals and fundamentals. And when I look at market, industry, and sector rotation, I want something that is very reactive. So Ron taught us how to use 2-day force. So I'm going to use those views tonight, but those are the 3 that I spend all my time with. So as I look here at the S&P 500, I'm going to clean it up for discussion purposes and just look at the moving averages. And what do I see? I see a box. Now, I see we got resistance somewhere over here. We probably got support. We probably broke through it there. And we've been bouncing around this area. If I go to a weekly view, the box here becomes very easy to see. So it wasn't so hard on the daily. Is that not a Darvis box that we're in? So we're up at the higher part of that Darvis box. And we had a shooting star on the weekly. So I think we're range bound until we break below or above, and we'll see which way we're going to go. But since we're closer to the top to the bottom, we've already rolled over, I'm certainly expecting, and we'll adjust as the market goes, that we're going to trade down to that lower trend line. If the market is really weak, we're going to trade down to the 200-day moving average. But I'm also aware enough that we could bounce right off this 200-day moving average and go back up here. I just don't think that's what we're going to do. But those are my three scenarios. Ian taught us all to have three. First one is we pull back down a little bit and then we bounce. If I don't hold at the 50, I'm going to test down here. Somewhere in this area, I would think, is where we'll end up testing. And if we don't test there, we don't hold there, this is the big risk that we come all the way down to the 200-day moving average. So I'm prepared that if the market bounces tomorrow off this 50-day, I'm not loading up the farm because I'm selling my kids and mortgaging my house because I want to go long. I'm waiting till we get up here, and then I'm expecting it to come down. I'm getting ready to short more. So that's why the market matters to me. You all got to have your own ideas, and you don't have to have mine. If I look at the NASDAQ, I will expect it to look a lot worse. It failed at the 50 here. It went down to the 200, which was probably the most obvious bounce point ever in the market, but it failed. It didn't even get back to the prior highs or the 50, and it's rolling over again. My concern is, do we hold here? And if we don't hold here, we're in really big bad area down here. So NASDAQ worries me. If the NASDAQ opens up tomorrow because Ukraine got settled, what's my upside target? My upside target is that 50-day moving average, and I'm not loading up the farm either because we're late in the bull. Somebody put out that we have a tired bull, and I happen to totally agree with that. I look at the Russell. It looks a lot like the NASDAQ, except we didn't hold the 200, but we had this Dragonfly Doji day and closed way above it. Where do you think this is going? New highland? Or back down here and retesting? I'm betting it's going down here to retest at the 200. If we get a rally, I'm worried about whether it can get above the 50. So we may be in a trading range here as well. But right now, I'm not going to make any big move to the upside. And frankly, now that I've learned how to short, I hope the market runs up. I can get rid of any longs I have left, and then I can short the daylights out of the market. Because that, to me, it would be happy land. And I've got a feeling we're going to get to happy land. Well, what about other things besides stocks? The VIX. You know, it's interesting to me when I look at the VIX because Ian used to tell us as long as the VIX was below 20, it was okay. That's because the VIX used to be a lot higher. So now the VIX, you know, you can get an idea of what high is. We're not at the highest high of late. Usually we get up to about 22, 23. We're at the 17. So we're not at a point where the VIX has run up that I expect the VIX to reverse. I expect that the VIX may continue to go up. And if the VIX goes up, actually we're down here at 15, the VIX is low. If the VIX goes up, the market will falter. So the VIX is not showing me that we're at a time that I expect the market to reverse to the upside. The VIX shows complacency, but it was up on Friday. I can look at gold. I'm not a gold bug. And when it broke up above the 17 here, actually let me back up. I wanted to see where I'm at here. I wanted to see gold get above the 17 and then hold above the 50. Gold has gotten above the 50 and then it came back down. You know, gold I think is setting up for a big run, but that's thinking, not knowing. And I think it's going up for a big run because the market's going to roll over, and I saw a lot of gold stocks starting to firm up. Silver, look where gold is, kind of at the confluence of that 8, 17, and 50. And if I look at silver, it's below that point. Silver looks a little weaker. To be all clear on gold and silver, if we truly were in a bull market in there, it's going to have to get up above that 200-day moving average. Someone pointed out about an ice hole failure on the NASDAQ, and I think that's a great comment. An ice hole failure would be if you failed. I look at an ice hole failure as if I trade below that 50, come up to the 50 and fail, then I'm going to come back to that 200. failing at a major moving average, often they take out the prior low or go to the natural place of support, which would be that major moving average below it. Oil, and I'm not sure the USO is necessarily the best way to see movement in oil, especially when Jeffrey can't even see the oil on this. Oil, black gold, it's healthier than gold, and we know oil is traded up above 100, so it is healthy, but it's really, sitting right on top of I bet if I put my big chart on, we'll see a squeeze, or at least starting to see a squeeze, a contraction, and nope, the squeeze was over here. But you see all the moving averages coming together on oil, so we'll see what oil is going to do. So I've now spent most of my time, and all I can tell you is that I'm worried about the market, but I hope you saw that I gave my 3 scenarios of what could happen, and what I'm waiting for is that market to open, move up some so I could start shorting, because I don't think we're going to see a big bull from here. I think we might see a little rally, fail where I showed you, and a much better chance for shorts. But I'm just guessing based upon how I do things. The second part of top-down investing is to look at industry rotation. Now, at Ian's meeting, at my meeting, we go through many different ways, and I'm just going to look at one way, which is using a view. So you'll notice in the T1 view, which is that all price and volume, weighted towards recent, but going back 3 weeks, HGSI comes with 149 industry groups. These are the same industry groups that Thinkorswim has been using. Problem is there's a lot of lumping. So I'm happy to announce, and George in fact couldn't announce it, he said sometime in the first week or so of May, maybe a little after, there'll be an update coming to everybody where we're going to go to Bloomberg industry groups, and there'll be about 190 of them. So you'll have better separation in some of the groups where you looked at things and wondered why some of them were combined in the same group. So this tells me that over the last several weeks, these are the types of things that have been working. Well, gee, 3 weeks ago I felt a lot better about the market, so how does that help me? So here's view number 2. I go to, well, you would go to HGSI strategies, Woodward and Brown top down. Let's try to think where, I don't want to send you to the wrong place, and I've got so many things here. You're going to look for a elder force rules, and what you're going to look for is, well, I'm going to use the index version. You're going to look for force up number 1, which means the 2-day exponential moving average is up. So force is defined as today's close minus yesterday's close times volume. You plot the force on a daily basis, and then you apply a 2-day or a 13-day exponential moving average. Your 2-day exponential average, and I'm no math person, but I think it includes today and yesterday's number. And 2 things drive it. Volume drives it, and price move. I don't think it's perfect because volume drives it too much. But if I want to know what's moving and price and volume matter to me, this is great for industry groups because it tells me what's working right now. And you could see that 149 groups is down to 16. And if we just step back, and I apologize if you can't see things, the video will be up where you'll be able to see them better. Healthcare facilities, probably go search by raw combo rather. Oil and gas equipment, I mentioned them before. Healthcare facilities and services, hospitals, and some of the management things which we'll look at. Gold, tobacco, big dividend rate, utilities, personal products. These are not growth stocks. Maybe the oil and gas equipment. So what you should see here is you've got some defensive plays. You got gold and silver coming back up, oil and gas drillers and equipment, but not exploration, and you've got some REITs. This is not what you expect to see, utilities and REITs, during a roaring bull market. If I highlight with the left mouse click, and then I right-click with the right mouse, and I hit Change to Index Group, I can rank what's working with this ranker, 2-day force, within oil, gas, and equipment. And I see a number of stocks that made it to my buy watch list. Although I'm not running out to buy, I still want to know what's working. If I double-click on the left mouse, I'm going to bring up my chart. It's the same chart you saw before, except I'm going to bring back my earnings and revenue. So pre-done for us in HGSI are the last 8 quarters and the next 2 of earnings and revenue. The caveats are the second quarter out will undergo plenty of revisions, so don't get married to it. The first quarter is the one that's probably the most accurate of looking forward. And that when you see 12-13, you see revenue change and EPS change, it's comparing it to the same quarter a year ago. From 12-12 to 12-13, your revenue reduced 7.9%, but your earnings went from 1 cent to 7 cents, or an increase of 600%. You'll notice now that the force index is painted here, 13-day and the 2-day, because I have volume. You'll notice that I have pocket pivots painted because I have volume. And the one thing I didn't tell you about these green dots are a trading system called parabolic stop and reverse, or PSAR, and you can use them as a trading system. People use them as a buy-sell signal when it flips, and as support and as your stops. Yes, this will be recorded. I'm going too fast because I'm putting 8 hours of work into an 1.5 to 2 hour session. And you know, my hope is that I whet your appetite, that you come to Palos Verdes in October. I have a few spots left in Florida in June. You do some of the weekly events that I have. You go and get Ron and Ian's newsletter, and you can learn to do the same things that I'm doing here. So here's Weatherford International. So one thing is, you want to be able to look at the right edge of the chart and get an idea of what that stock's going to do. So this is the best of the best stock in the best group based upon the criteria. This is a buyable gap up, according to Morales and Catcher rules. It painted a green bar here for a buyable gap up. It's bongos, which are, they take a while to convert, but they're a momentum indicator. Both the long and the short duration one are positive. The forces are both positive. You have a PSAR supporting the price, so that's still in a buy signal. You had massive volume come into the stock, and you had a deep blue kahuna. Since the force is positive and the kahuna is blue, you had what Ian would refer to as a force kahuna. So here's a stock. Absolutely, it's extended after the buyable gap up. But I'll tell you, there are rules about buyable gap ups. Read Gil and Chris's book or books to understand what those rules are. But they have stops. They tell you when to buy them. And this is a stock that I put on my watch list. And I put it on, and I looked at the earnings per share were massive coming into the stock. And it's the leading stock in the leading group. The next one, National Oil Well Varco. Everything's green. Pocket pivots the last several days. Looks like decent volume. And I might look on a weekly view, so I feel any differently about it. I see a cup. And I don't think this is a cup, necessarily a cup and a handle, but I just think it's another cup on top of a cup. But whatever it is, you know, it takes out this right side of the cup on the previous cup. You see the group strength there. This might be something that's interested to jump into. Now, you might notice, and if you're smart and clever, you would have said, Jeff, how do you have a pocket pivot on a down volume day? And that's simple. In the way I've got my chart set up, if the close is less than the open, I get a red candle and a red volume bar. Yet that close is still higher than the prior close, so that was an up day. So that volume, although it's red, is really on a positive day, so it is correct. It's a pocket pivot. I would look at the next one and see New Park Resources. I'm going sideways, broke above the 200. So this one's interesting. I got massive volume, a pocket pivot, a big kahuna, a mobile breakout in a squeeze, and all my momentum indicators have turned green. These are stocks that look like they want to go higher. They're in the best group. They've got a lot of momentum coming into them. These are the types of stocks that I like to buy. So enough of this group. I go back to this chart. I right-click back. I highlight healthcare facilities. I right-click, left mouse click, and I now have a bunch of hospitals, which surprised me to no end. And to be honest, I ignored them until I saw how many hospitals made my list. So if I put a weekly chart on, they've been basing for quite some time. And they had a big run-up with Obamacare because of the fact that now everybody's going to have insurance and they'll be able to pay. And they've gone sideways for a year. I think something's changed. And the reason, if you look at, or may be changing, you had a Bible gap up on Friday. All my upstairs technicals turned green, huge volume in a kahuna. I don't like the volume signature. Something's going on. This is Tenant. Here's LifePoint. Sideways until Friday, everything turned green. Mobile breakout on huge volume in a kahuna. Something is happening in this group. Universal Health Services. Big gap up, mostly green above, lots of volume in a kahuna, had a pocket pivot the day before. Something is going on in this group, and therefore I have to pay attention. And you'll go and look at them yourself, but these are the groups, if you want to go long, that I look at. Healthcare services. Now I thought HCA was also a hospital, and it is, but I guess they do more than just the hospital. Looks just like the hospital. This is my favorite one of the bunch, by the way. It's got positive earnings per share growth. It's not necessarily, this is a weekly. It wasn't tight on the daily, but it's tight on the weekly, lower left, upper right. Everything looks good on the technicals. My bondos look good. I had a DMI crossover there. Excuse me, a Bible gap up there. I had, you can see the gap there, multiple pocket pivots, volume in a kahuna. This is, to me, is the one I would want to play with. When I saw this one, I changed my mind, and I got more interested in the hospital stocks. Healthways, this is a company that does disease management. They take costs out of the system. They have basically been dead money since 2008. So it's going to take me a lot to change, in my opinion. But the time is right for this kind of a stock based upon where healthcare reform is or not. And you know what? It's breaking out. Mobile breakout from a squeeze with a mobile breakout. Everything's turned green, big volume in a kahuna. Anybody in besides me? I love this pattern. I think this is an interesting story. So when I do my top-down investing, I'm going to go through the top 10 groups. How about gold? I mean, now's probably a time to think about adding gold to your portfolio. And the reason why I say it, this may not be the best chart to show you because there's some M&A discussion, but gold is starting to come off the bottom. This is Newmont, one of the big guys, looking at being acquired by American Barracks. You know, it's not a growth stock. It's not breaking out to new highs. The fundamentals have been awful. It just feels to me, as I look through some of these smaller ones, that gold wants to go higher. It's put in bottoms. It's starting to trend up. It's got lots of overhead supply and lots of resistance to go through, and it's going to be, you know, things that are going on in the world are going to matter. This is probably the best of the charts. This is AU. There's your cup and a handle. A kahuna coming in on Friday. Everything's green. Mobile breakout from a squeeze. How would I handle AU? I put it into my trading system tomorrow. I would, and as soon as it trades above that PSAR dot, then that dot will go from resistance to support, and that would give me a buy signal. So in my meeting, I'll show you how I translate these things into real time and what I do. And so I'm going to stop and move to the downside, but I would go through each of these and find the best of them and put them into a buy list. The fertilizer group I mentioned, I looked at Mosaic and Agrium, and I see stocks that broke above their 50, Mobile breakup from a squeeze, and a pocket pivot on Friday. Everything is green. I don't like their earnings per share growth. There's some M&A speculation on this one. I mean, they're down from where they've been. And then I looked at seasonality, and they look good on these charts. Well, they look okay on these charts, but from a seasonality perspective, it's the wrong time of year to buy fertilizer stocks. So that was with Magenta. If I want to know what's not going up, I go here. First I'm going to go right-click back. So I'm in my indexes, and I look at force down, force down. So force down here, 2-day EMA down, and these are the groups that are not working. So if I wanted to look for shorts, the shortcut would be to come here, right-click on semiconductors. Want to see an ugly chart? Freescale. Love its earnings. Here's when earnings will get you in trouble. Look at this massive earnings per share growth, and look at what happened on Friday. I'd rather short personally more expensive stocks, but if this stock trades up to the 17, or excuse me, up to the 50 here and fails, that's a nice little failure, and then it's coming down to the $17 range. It would be very shortable. I wouldn't probably short it yet. I'd rather see it pull back up to that 50-day. Everything turned red. This is what ugly looks like. Kahuna to the downside on big volume, pocket pivot down, mobile breakout to the downside, and my bongos and forces went red. So the worst of the worst are coming up here. Broadcom, gap down, gave a doji. Probably wouldn't be interested in shorting that because that's a signal where it could go either way based on how it opens tomorrow. Micron has been a leader. It's rolling over. I own some of this long. I'll give it the 8-day. I'm not shorting it. It's above the 50 and 200. It's still in an uptrend. But I'm finding weak stocks. Texas Industries, interesting. This one tried to pull up here and then sold off hard the rest of the day. That might be one that I start to look at. But I personally want to short stocks that have broken through the 50 after a big uptrend and then fail at the 50 and come back down. I want to buy them after that retracement. So when I like to short, and when I say short, I might mean buy puts, by the way, I want to get the stock here. When it's pulled back or retraced, this is where I want to short it. So on something like Texas is, well, not this one, but Freescale, if I can get the stock to retrace to the 50 and roll over, that's when I get a lot more excited. So you could just go through each of these groups. Oil, gas, exploration. These went from strong to weak. And I'm going to watch these closely this week because they have been big leaders. Here's one that I thought was an interesting potential short if the market rolls over and this group does poorly. It's got to come down some, perhaps before I get too interested, but they sold off hard on Friday. The forces went negative and had a kahuna to the downside. So the little guys got hammered, and let me see, then Goodrich was one of the little guys that got hammered. Well, this doesn't look hammered. Where's the ones that got? Several of these sold off hard. Athlon sold off hard the last couple of days. But selling off hard, they're still above their 8-day exponential. It still might be an interesting place if the oil turns around and goes up. So the second thing that I do after looking at groups is I do top-down investing. I go through the top groups, and I look for the top and worst stocks in the groups. So for the essence of time, I'm going to take you into shortcut land. So shortcut number one, and the third type of view I'm going to call the force up and down as one view. And everybody's different. all securities, and you can see the worst, I put that force onto stocks, and the worst stock from a force volume, price and volume characteristics the last 2 days was Amazon, and Amazon gives you the daily double. And what I mean by the daily double, it gave you a big price move over the last 2 days on volume here, 16 million shares, 18 million shares a day. So it's telling me what did poorly, but I'm going to go into scorecard, and I'm just demand, and this is a balanced view, both fundamental and technical demand based on force index, dollar volume, and group movement, combo-driven list, and most attention to the top 10 stocks. So both technicals and fundamentals matter, and no shocker because there was a bid out there despite the fact that pharma sold off. We're going to look at a couple of these because there's some good stocks here. Since pharma and biotech have been weak, but Valiant put a bid in on Allergan, and I just love it when I didn't prepare and I get what I wanted to see. Pull down to support at the 200, started moving up, and then last week on Monday night they said that Ackerman and Valiant were going to come together to put a bid in on Allergan, of which Ackerman owns 9%. Notice where the stock traded up to and stopped? Right at that 50-day moving average, and it failed there. You got an ice hole failure there, but with that M&A stuff underneath, I probably wouldn't necessarily short this one. Good earnings per share growth, and Valiant is one of my biggest holdings, although I put a married put on it up at 145, so I haven't lost anything on it. And then I wrote some puts down here to pay for my married put, but you could see the big move up that Valiant had. Much of that move was driven by hysteria around acquisitions. The second one on the list, Allergan, is their target. And you could see that Allergan ran up. Now, it'll come up or come down. If they don't buy it, it's going to come back down, of course. If another bidder comes in, it will go even higher. And then we'll see where they end up. And the deal is stock and money, so they're going to be tied much to what Valiant stock does. The next one with this view is Weatherford. We saw this one already. The next one with the view is SunPower. Now, solar has been taking it on the chin. But here's a stock, SunPower, that had a big run up on the weekly chart. Like everybody else, rolled over and pulled back to its 50 weekly moving average. That's about 250 day. Let's go back to the daily. It had a massive move on Friday. I think somebody told me it was like 9%, or it had a gigantic, I don't remember what the percent was. Let's see. It's traded, let's see, here it is. It was up 6.75% on Friday on earnings. Viable gap up, I actually had some calls on it because of this formation here with the bottoming tails. I'm not sure if I'm going to hold them or just get out and say I made money and smile. This is a bad market. You can see it's been going sideways, but it had a massive move on Friday. Mylan, I don't own this one. This is a generic company. Somebody suggested a TradeStation. Okay. Actually, what I'll do is I'll turn off. Mylan is pulled back. I like this chart a lot. I had a number of pocket pivots, gigantic volume on Friday, a bullish engulfing pattern, a PSAR reversal, and everything except for my weekly bongo went green, and I had a PSAR reversal and a squeeze, which is one of my buy signals. So I'm going to put this one on my buy list. It's been in a pullback, but it's been a leader for a while. Pull back to a major moving average, and it's running again. This might be something that you might want to look at. Dresser-Rand, don't know much about this one, broke above the 200. There's another one, shoes, Questcore. I'll look at Altria, and then I'm going to go to another one of my shortcuts. So Altria is a tobacco stock. You know who they are. Philip Morris. There's a number of these. These stocks work well when the market rolls over. You could see a mobile breakup from a squeeze. Everything is green on my bongos in force. You could see the 8-day cut through the 17, which is above the 50, which is above the 200. You could see that the group index, which I haven't pointed out yet, has made a massive move up. This is a group that's on fire. Why is this group on fire? It's on fire because it's defensive and it pays a big dividend here, 4.9% for Altria. The second view, or now this will be view number 4, that I spend a lot of time is I go down to miscellaneous and I look for sprinters. Sprinter one step with bongo. These were designed by my good buddy David Gallardi, and it is finding decent fundamental but really strong technical stocks. If you stand back and look at this chart, you notice that it's all green and yellow under EPS, relative strength, and group rank. That predominantly it's green under ERG. You had 3 things that are less than 240 that painted yellow. Accumulation, distribution are all A and B. Many of them are box stocks. They all have a green bongo daily. So these are well-behaved stocks. And if you look at these and what comes to the top here, I mentioned truckers. The first 3 of them are truckers. That's how I found my truckers, because this is one of my go-to lists. And I see Old Dominion freight lanes, everything turned green above. Would have been a good buy back here with a mobile breakout from a squeeze, but it still had some pocket pivots and kahunas this week. Certainly not overly extended, in an uptrend, makes money with good earnings per share growth. If you don't own a trucker, maybe you want to own Old Dominion freight lane. SAIA, another trucker, I think it had earnings or something on Friday, if I remember correctly. It broke out, it pulled back, it still had a mobile breakout from a squeeze. Kahunas and pocket pivots, everything is green, it makes money. And I don't know from Adam Pam, which is a good thing because I'm married. One thing that might make me, that was a joke, make me nervous is Swift. I think they missed on revenue and they got hammered. Notice where they stopped? This would be a great place to see this 200-day holds and the stock starts moving up again. I might get interested, and because it's done that before. It's had a big sell-off, and then it starts to run back up from that point. But this could be a negative on the truckers. Lattice Semiconductors, a cheap semi, even though semis were weak, this one was a, come back, a leader. It's been nice base. Everything's green, mobile breakout out of a squeeze with a kahuna, huge volume, Bible gap up on Friday. I love it. And cheap stock, makes great money, and is growing. So scorecard view, ranking stocks with a balanced technical and fundamental. Sprinters, which is mostly technical, but they have to have good fundamentals too. And then the next thing I want to show you is a group inclusion filter, and then I'm going to look at your questions and say goodnight. So I bet George is sitting there thinking to himself, show him the smart views, show him the smart views. And the reason for that is the system does it for you. So I'm going to leave up my scorecard view, because that's how I like to look at things. Now, actually, I have a little different scorecard, but I just changed the things that are listed from my spreadsheet, not what determines the scorecard. And I'm going to open up my database. And I'm going to point out, again, that we have 3 categories. Everything that I create myself goes into user groups that I put together, or I upload from someone else. The smart groups incorporate a view that is put together and perfected by Ron, Ian, George, myself, whomever, that allows you to do what I've just spent the 2 hours doing in a matter of just a couple minutes. So let's say that I want to look at sprinters. I go Smart Group, David Ghilardi, sprinters. So these are the stocks that on April 25th, end of day, made the sprinters. Most of the stocks we saw before, there's your Old Dominion. Okay? But I kind of like Jeff, and I want to know about mobile breakouts from the squeeze. Remember I showed you in EdgeRater how to do it? They're already done for you in HGSI. These are the stocks. Let's look at Deckers just to prove that it worked. These are stocks that met the criteria and had a mobile breakout from a squeeze. So here's your breakout. Green is the mobile breakout. Yellow is the squeeze. All my technicals up here turn green. I had a pocket pivot, big volume, and a kahuna. Someone said that they wouldn't buy Deckers that I was listening to over the weekend. I don't know. It set up, you had a deep pullback. Maybe that's a handle, downtrending. Volume just came in with a kahuna and a breakout. Maybe that's a weekly, not a daily. Maybe you want to look at Deckers. So I use these smart groups here to help me find stocks. Another thing I thought was interesting was First Dollar and Dollar General are beaten up merchandising companies. Looks like it's putting in a bottom to me. Now, I'd like to see it get above this 50 and this 200, but I had a mobile breakout from a squeeze and a kahuna on good volume Friday. All right, how did I find this? Showed up in the smart group. All right, one of the things that I like are stocks that are an uptrend that pull back to their 50-day moving average and have a kahuna. Okay, let's look at Aon. Let's see if it met my criteria. Is it in an uptrend? Well, kind of, sort of. It's definitely in an uptrend if you look at the weekly and it pulled back. So it's in an uptrend, which is what I like. It pulled back, and several criteria have to be met. It's got to be within 2% of the 50-day moving average. It closed right above that 50-day moving average. And it had to have a kahuna. It had a kahuna. So here's another stock potentially for a buy list. It's in basing after being in an uptrend and a pullback, and you have a big momentum day and got above the 50. When I talked about the indexes, I said I'm going to look for them to retest the 50 and fail. I'm going to look for this to retest the 50 and go further higher. So that's why I try and identify stocks. Again, this one looks like it's sold off. I have to go to weekly. And by criteria, it's been an uptrend, sideways, little sell-off, and now it's right adjacent to its 50-day moving average with the kahuna. I'd rather get stocks that are in better uptrends, but you see the pattern, which is uptrend, pullback, sitting within 2% of the 50 with the kahuna. So that's that smart group. How about going to Woodward and Brown? How about best of? I like to look at this list every day and hope that I own a bunch of them because these are the best stocks based upon the traditional Woodward and Brown criteria. How many of these did we see already? Allergan, we saw. Weatherford, we saw. Valiant, we saw. SunPower, Mylan, we saw. So most of these I pick up on top-down analysis anyways. They have a smart group of best stocks under $15 for those that like to buy cheap stocks. These got killed. For the most part, little stocks got hurt on Friday, and even these that were the best of the best over the last several weeks, you could see how hurt they got. You might want to find things that are, this is Ron's, I think, his secret weapon, which is finding stocks and groups moving to the upside. And he has stocks $1 to $15 and those that are over 15. And again, most of the stocks that we found, the better stocks, are going to be in this list. And when I look at his combo rank, top stocks to trade on technical and fundamental factors, strong earnings and revenue growth, strong relative strength, group rank, and accumulation, that's what's ranking them. And so he's bringing the best stocks that are being accumulated and moving to the upside. And these are done automatically for you. And now, and then I'm going to show you a couple things, then I'll go to questions. Gil Morales, Chris Katcher, these are the ones that had a Bible gap up. Many of those we picked up in our searching. How about which stocks had a pocket pivot? Or you want to know what stocks to short? Code red, pockets, these are potential stocks that you might want to look at shorting. Now, you have to look at their charts. You have to know how to short. But if you want to look for stocks that are showing momentum to the downside that meet their criteria, these are the types of stocks they look at. Now, I'll introduce you to another view. Go up to Morales and Catcher. Yes, I need to clean this out. Code blue and red secret weapon chart. He uses a open, high, close, not a candlestick, bar chart rather. And you've got bongos going red, force red. You've got a phoenix. Excuse me, you got a kahuna to the downside. He's got, a pocket pivot to the downside rather, and the volume. So he goes through these charts looking for this picture here of the reds. This looks like a shortable stock, YPF. Federated Investors. And this is a screening technique that's done automatically for you in the program on a nightly basis to help you find stocks for shorting, or if you thought the market was going up, the best of the best. And there you got your Mylan, your Aon, your HCA, your Deckers, your Dollar General, several of the stocks that we looked at. So I'm going to show you one last trick, and then I'm going to look at your questions. So I showed you a bunch of smart groups, but you don't want to take that much time. I get it. I used to have a job. So let me show you how to make this a simple operation. In the designer here, tools, group inclusion report. And then you're going to do a couple of things when you set this up. You're going to hit clear. You're going to make a group from report. You're going to call it Sunday. I'm calling it Sunday Live Webinar. You're going to call it whatever you want. I only care about 10 stocks. And if these smart groups, specifically the bullish ones that I identified, the sprinters, the best criteria, best of, under 15, demand, ERG, if these groups each have the best stocks in the market at a given time, don't you think the best stock might be found in a lot of these groups? So I'm going to look for stocks that have a high number of falling into these searches, all based upon the fact that if these are very bullish groups historically, that if my stock is in lots of these groups, it's probably a good stock to buy. I'm going to hit OK, and then I'm going to make it the pick. That doesn't matter. I'm going to say no, I don't want an index. So a couple things are going to happen. So the markets are about the same, doing nothing. This is a group inclusion report. I know you can't read this because it's super small. I guess I could do this, and you can see what stocks were there. And it's basically come up with the stocks that were in the most groups. So these are the bullish groups, and this is how many groups they were in. Now I'm going to shut that down, and I'm going to go right here, and I'm going to say, I have my Sunday Live webinar. I have 10 stocks. So those top 10 stocks got put into a group. So before I say good night, I'm going to go back into a view that works for me, because we're all different, and I'm going to look at these very quickly and tell you what I think. CXDC, China Plastics, had a big move over the last week. It's a cheap stock. I don't know anything about it. I'm not a big China bull right now. I'm going to pass. However, I just saw the volume. It's not enough volume for me to get excited, but this volume here is huge compared to where it's been. So I might do a little investigation. It looks like it's peaked anyways, but here's a little Tiddler, auto parts and equipment. I might put that on my radar screen and see what it does. Lattice Semiconductor, I love this stock. I already showed it to you. Bible gap up from a kahuna. Lithium Motors, several of the automobile dealerships popped up. Ashbury, Lithia, I don't know, Auto Nation, I don't remember which ones they were, but several of them on my review, Penske Auto Group, et cetera. That tells me that's a wolf pack. Something's going on here. They've got great earnings per share growth. Let's look at them on a weekly because they've been sideways for a while. So big uptrend, pull back to their 50 weekly moving average. They want to go again. So this might be a stock that if the market goes up that I might want to be nibbling. Mylan we already talked about. This was that generics company breaking out with all the different positive signals. This is that freight trucker, Old Dominion. Don't know anything about PTIE. This is a small drug company that to me it looks like it's going sideways. Everything is green. It's in a squeeze. I know Harry Boxer talks about it. I don't know enough about this to comment except it's going sideways. It doesn't look like it's got a ton of volume in it. On a weekly, not my cup of tea. The volume, if I go up here, let's see, it's $276,005. The daily float's 1.2 million. Ghilardi could buy the whole daily float. I can't buy a stock that Ghilardi can manipulate. Questcor, this is a takeout stock. It's been one that I know certain people like Bruce B on the website have had for a long time. This is a very volatile stock that runs up and the shorts hammer it, and one of the other companies put a bid in for it at this price range, so I don't pay attention to stocks that are under acquisition. SunPower, we already talked about the big move up on Friday. Synergy Resources is a small oil exploration and production company. Everything is green. Again, a lot of these little guys gave back something on Friday. It makes money. It's got good share growth. A lot of volume coming into the stock, probably worth paying attention to. Triangle's another little one. It too sold off on Sunday. So I've now shown you a number of, I think, unique ways that I use HGSI and I make a lot of money. Now, I don't have a model portfolio, and that's because if I did over the last couple of months, you would not want to listen to me because you can't do a model portfolio that you don't actively manage in a setting of chop. I did a year-end portfolio meeting last in January, and I outlined my performance. And using these things that I show you, I was up 68% last year on a big portfolio. I am not up like that this year. I'm up for the year, but it's much more modest. And frankly, the reason why I'm up for the year is not because of my longs. It's because I've been writing a ton of option premium on some of my positions, and I've been protecting with some protected puts, and then I write puts way below the price and collect premium against my protected puts. This has been a tough year because you're not getting the long moves of the market. You see if there's anything here that. So yes, this will be out later. Jim, I haven't read your note, but we said the same thing about the ice hole failure. I answered the pivot tables. If you know how to do Excel, you can do pivot tables. It's a great program because of how I export it. George, I don't know if there's a way to use the data in Excel without the way I exported it. So I think it certainly works the way that I showed you. Anything that I have that I create will get put in, so that chart view will be in a new update. Something else that I did, which I did it for George Lee, I tried to show you guys last week, was I'm getting very impressed with volume as a driver, and so I put together some views, and let me see if I can find it today. And these views were looking at big volume moves, and that's not the one I'm looking for. And I'm going to include those as well. Here it is. So I've got this set up, and looking for stocks that did something different. And so this is a view for 5x volume with a tight filter. I eliminated things that were not stocks. I eliminated preferreds and warrants and real cheap things. But I just want to find things that had some major volume come in. So here's one. This is VDSI. It's a security company. Bunch of kahunas, should have ticked us off. And then massive volume on Friday with a huge move up the last couple of days. Everything is green. It's the kind of thing that might be worth looking at. DeVry, I'm not a big fan of these education companies, but this is one that had a big move and big volume on Friday, so maybe I should become a fan. And all I'm looking for, here's Healthways, which is we looked at before, the disease management company. I'm just looking for finding shortcuts so I don't have to look at 600 charts. I look at the 600 charts because I want to do a good job for you. During the week, I use my shortcuts. Here's that hospital. And so these were picked up. Here's a trucker, Echo Logistics, all on the basis of big volume. So I'll be putting my volume buzz filters into my smart groups as well, so you can use them as a smart group. Anything else that's in here? Okay. Fortunately, the guy that's left with the question about the views will be coming to my meeting already, so we'll be fine there. So, Steve, he was concerned that I referred to views in my charts and views into my warehouse, and they both are views, but they are different things. They're created differently. The chart views, this is probably the most customizable charting program on the market, and the warehouse views is just a combination of a filter and a ranking module. And at Ian's meeting, which I love to attend, and I've been to for the last decade, twice a year, if not more, and in my meeting we'll get more detail how we do that. George, do you have any questions that are outstanding that I don't see?
No, you've got them all, Jeffrey.
All right. Well, we still got a bunch of people here, so I can't. Thank you all for coming on. Thank you all for staying. Thanks for supporting all of us. And just a few things I pointed out. This is a couple comments. A lot of the stuff I showed looks like it's a lot of work, it's hard to do, and there's a huge learning curve. I've been using the product ever since the product came out. I still learn from it every time I use it. But I can get 90% of the use in anybody that I spend 4 or 5 days with and make it a very or maybe not 90%, but to a point where you find great value. Don't be scared off by the horsepower. I often joke that in this view here, whoops, I don't want to do that. You've got two things. You got the car and you got the toolbar. This is a Ferrari. It's not my Ferrari. I have a different Ferrari, but my Ferrari rotates through eventually. And I'll tell you, this one up here, the toolbar has got more power than the Ferrari. My wife can't drive a stick, and she won't sit in my Ferrari, so all that power doesn't do her any good. But if she let me train her, she might even like to drive the car. This thing here is extremely easy and intuitive, but you got to get through the language and understand the power of these buttons. So come to the webinars, get the newsletters, come to the live meetings, and by the time Ian, Ron, and I get done with you, you'll be your own guru, and you'll be like me. This is the program that you'll be using end of day, and then everything else goes around it. And I showed you earlier on the flexibility of bringing it into Excel and into other programs. And not only will we be getting a better industry group structure, before too long we're going to get some real-time updates. On that note, unless anything else came in, George, I think I'll say good night. And I'd like to thank Ian for all that he's taught me over the years, and thank him for joining us today as well. Good night, everybody.
Good night, Jeffrey. Thank you.